Kovacevich joining me right now, the former Wells Fargo chairman and CEO. Wells Fargo, like all those other financial issues, under intense selling pressure. And when I ever see anything like that, Richard, and very good to have you, and Happy New Year.
Thank you.
I wonder about 2008. You can't help but draw the comparison. Financial issues took a disproportionate hit, and then the selling begot more selling. Do you ever worry about those type of historic anomalies?
No, I think the conditions in 2008 were unique. You had 20 financial institutions that are all gone now that originated securities that should never have been originated. You had rating agencies that misrated them. You had Fannie and Freddie buying this junk, which they should never have done. Only a government agency would buy this. None of those conditions exist today. What you have today, I think, is simply what happens when central banks interfere with markets. Bernanke and Yellen said they wanted to encourage people to go into risk assets. Well, that creates bubbles. And when you have QE1, QE2, QE3, and they're still buying long-term bonds, you get into bubbles. And the faster those bubbles break, the better. And so that's what's happening now. The bubbles are popping. It happened with high-yield bonds. It's now happening in the stock market, and that's good.
So you don't fear like a spillover? You don't fear a spillover effect that what starts there become fast market conditions, fast market selling, that just spreads like a contagion? No.
As I said, I think it's influenced by inappropriate central bank interference with the markets for 7 years, which they shouldn't be doing.
What is your sense about that bubble in bonds, more to the point, and interest rates? I'm guessing the Fed wants to change that by slowly hiking rates. A number of officials have, over the last couple of days, said there's nothing on the horizon to indicate a change in that stance. I'm paraphrasing here. What do you think about that? What do you think about whether that could mitigate the blow or complicate it?
No, I think they should. I think the neutral equilibrium rate for Fed funds is somewhere between 3% and 4%, and so we're a long ways from that. So I think the Fed should raise rates slowly, and should get to a Fed funds rate of about 2% sometime in the middle of next year. The 2% rate is a good place to be.
But that's a huge jump. That's a huge jump. I mean, to get to that equilibrium that you alluded to, when do you see us getting back to that?
Well, what happens is you get to 2%. If the economy is moving too hot, you're only 1% away from the equilibrium rate. Remember, if it's below the equilibrium rate, it's still accommodating. If the economy is too slow, you now have room to reduce interest rates. So you need to get to a place where you can move in either direction, because we don't know what's going to happen a year and a half from now. So if you wait too long, you have to move really fast to get to 3 to 4%. That could put you in a recession. If the economy slows and you're at 0, what do you do then? There's no place to go. So as long as we have low unemployment, and I think it's possible that employment actually reduces from here, the rate of unemployment. Right. As long as you have low unemployment, you should be you should be increasing interest rates, and what they should for sure do is stop buying long-term bonds, so that we don't get bubbles in both the bond market and the stock market. And they are still doing that, unfortunately.
Yeah, easier said than done. We'll watch closely. Richard, thank you very much. Good seeing you again.
Okay, good to see you, Neil.